Today, we're focusing on the Fed funds futures curve and why it's so important for equities and maybe even why equities are rallying here. And then we're going to have a look at euro yen and what's going on with interest rate differentials there and why it could be a really big bear of a pair. And then the trading takeout today is why we really just always have to focus on interest rates, strip everything back and get back to the basics of that base of the pyramid, which forms every trade idea. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So in front of us here, we have the Fed funds price term structure. And this might look complicated and whatever, but basically I want you to ignore this table. This table is just showing this graph, but in obviously tabular form. But the key thing to note here is the scale. Okay, so scale's decreasing. So wherever the plot is and it's lower than last time, it means that rate hikes are being priced in. You basically just take 100 and then minus whatever the number here is, and that gives you the basis point range for the Fed funds target range. And then each different line is what the curve looked like at a certain date. So I want you to focus here on the purple one, because what this is indicating is the 2nd of October's number. And basically it was indicating that on the 2nd of October, the Fed funds futures curve was more hawkish than what it is now. So if you look at the blue curve here, it's shifted up. You can see the cuts have started to become priced in roughly around ZQQ4, which is next July, I think that contract is. I can't remember the contract names off the top of my head right now. But basically, this is why risk has started to rally again. So if I share the ES chart here, so this is the S&P 500 E-mini futures chart, you can see that since last week, when the curve chart started to shift, you can see that the futures market started to tick back up and the S&P 500 moved back up. And it's really purely because of this, change in pricing of interest rates. It's become not far more dovish, but a little bit more dovish quite quickly. I'd argue that this is related to the war. And what is probably occurring here as well is that traders are probably betting on it not being widespread. It's probably betting on it being isolated. And that means that it's likely that it's not going to spread, and that the economic data is suggesting that the path that the US is on should indicate that no specific issues should crop up, maybe with inflation and things like that. That's probably my bet here. If we look at the oil curve, it's still in backwardation as well. So the oil futures curve is still in backwardation, which means that, as I spoke last week, demand for oil in the future is less than what it is now, basically. So it's showing like some recessionary signals. And this is probably boosting the change in the interest rate curve as well. So if we see a sustained shift to the upside in this curve, you can probably guess that unless we have a credit or liquidity event, we'll probably see a sustained shift in upside in the S&P 500 as well. Now, in the same vein as the last video, we're looking at interest rate differentials again here. I think that's a key topic that we have to focus on, especially when there's quite a bit of noise going on elsewhere in the market. And this is euro yen that I want to focus on, because we're reaching a stage where I tend to see certain things that happen in terms of what, central bank members start to say. And yesterday, the ECB came out and they said that they weren't concerned about Italian bond yields increasing because it was a factor of Italian deficits and not necessarily to do with anything else. Now, when they start saying things like that, you have to start thinking to yourself, okay, well, they kind of are concerned, actually. And then just this morning, ECB's Villeroy, let me just get it up here. ECB's Villeroy says interest rates are now on a good level at this stage further rate hikes are not the right thing to do. Adds the Israel situation is no reason for us to tweak inflation prospects for now and still sees inflation at around 2% by 2025. Now, for me, that instantly screams dovish. For the market, it's not necessarily seeing it that way just yet. And I think there needs to be a few more components that are added in. Now, in my opinion, I think we actually trade up to about 164, about this level. So there's 163.72, but just above there in euro yen. Before we start to see some more bearish moves coming in. And, there's no specific reason for that level other than this is a prior high, but you tend to see that certain things start occurring around there. So when you start to reach prior highs, like key long-term prior highs, I've spoken about this before, with regards to key technicals and key prior highs, you tend to see that certain comments can shift the market in certain ways. Now, let's have a look at the daily moving average. Now, if you can imagine what occurs at these sort of highs, let's take, for example, here, okay? So you can see that all the way up, the 200 daily was supporting the market. Let me make this a bit bolder, actually. So if we make that yellow and then make it like this. So now you can see the 200 daily nice and easy. So if you can see this long trend here from this bottom, what I'm looking for really is a shift up here and then back down. Now, this is going to be a very, very long-term move. This could play over a year or so, but the fact of the matter is you want to be looking at what is occurring up at this level, in my view, because we had this happening, which was back in 2008. And I think we're going to see something similar with regards to the euro and yen. Something's got to break because the yen can't keep getting weaker forever. It just doesn't make sense to. So key is to focus on the long-term direction here while trading that long-term theme on a shorter term basis, in and out, getting in and out of the market, swing trading it, but keeping that longer term direction and thesis in mind, especially when we get up here, because you want to be looking for people to say, oh yeah, euro yen's going to keep going up here, when really you want to be looking for reasons for it to go back down. So you want to try and get as many people knocked out of the market as possible. So during times of extreme noise, we want to kind of strip back what is fundamental to markets and how asset prices are priced relative to each other. And that is really purely due to interest rates and bond yields. And that's why I really wanted to bring the example up of euro yen, because it's a fantastic play there to see, okay, we've got yields that have been recently historically high versus yields that are kept very, very low. If we start seeing those yields come back, then the euro should sell off and the yen should turn bid. I think it's absolutely imperative to keep interest rates at the forefront of everything that you do, because they are the fundamentals of the market. Everything is derived off of interest rates there. You could have whatever indicator that you want in terms of the macro side of things, it's going to be linked to interest rates in some format. So why focus on the small little nuances when you could focus on the core concept, which really, really drives the pricing of certain asset prices?